In this video, we are going to be analysing Virgin Galactic Holdings, ticker SPCE. If you want your own stock analysed, throw that in the comments. We'll get round to it when we can. Now, what we can see is we're currently sitting around $5.20. We're up just under 6% on the day. What are going to be those key targets if we continue to the upside? So $5.60. This is our second deviation on the 6 month. Again, 6 month chart on the left. We have a 1 year chart on the right. I would really be paying attention to this 560. Again, resistance. So if you're a long bias trader, that would be a target. To me, someone who kind of is more of a reversal trader, this is where I'm going to be focusing on it more short bias. And again, what I really like with SPCE is we can see the 6 month is downtrending, the 1 year is downtrending. Really, if I'm going against a trend, I like to be following the longer term trend, which is downtrending. So if I can catch this short bias, really just increase those odds of really catching that short bias trade successfully. So 560 will be that first resistance. If we break higher, we then have the $6. So again, I would kind of use this as a range of resistance. First time we come into here, again, really looking at it short bias. We at a minimum tend to play it as a pullback. So, we have a target of say $5. That's where we lock in some profits. We move our stops to break even. If we continue higher, obviously then we'll get out of the trade. But if we do continue down, and again, those are going to be the home run trades where we can get all kind of that downside potential. If we break that, we do have further resistance at 640, 725, and really a final one at about 850. My main focus though would really be this kind of 625 to 640, and the reason for that is our third deviation on the 6 month and our third deviation on the 1 year. So third deviation, my favorite level to trade, because that is a 99.7% probability that, 99.7% of the data should trade within that range. So if we start to see a stock break above that, we tend to believe there's going to be some sort of reversal happening very soon after. Again, it's never going to be 100% accurate. Nothing is in the stock market, but that's why we always hedge our risk. So we don't really have to so-called place stops on it. We don't have to stop up if it goes up, 100% and then falls. The way we can stop getting faked out by these, temporary moves, even if for the next week or two it continues bullish, and then that's where you get the overall pullback. Again, if we just short the outright shares, we buy the calls. Again, you're always going to have a defined risk until the options expire. So again, if options are coming into expiration, we'll close out those shares if we're not yet in the money, because again, we still then have that defined risk. If the short shares are down, $1,000, then the call option will be up about $950. So again, you can get defined risk, and that's how I look to play these opportunities, because again, the majority of the time, if a stock trades above these third deviations, it does not hold out there for long. So usually I'll look out for, a month to 3 month out expirations. That's usually the longest I'll hold the short. If it doesn't kind of come back in the money by then, we'll go on to the next opportunity. And again, these stocks are quite good because there is a lot of outstanding shares. They're not hard to borrow. What this does mean as well is you don't then have to really pay these short locate fees or holding them short. You don't really have fees to be paying on that, which again, you do need to account for that if you're trading really these micro caps or the small caps. Sometimes you have to pay to short them, and again, then that can eat into those profits. But that is the breakdown on SPCE. Let me know if you're trading it. If you want your own stock analyzed, throw that in the comments, and why don't you check out this analysis video.